All right, the last time we did a video, that I did the video with you, we talked about Russell finally joining the party. Well, and whether or not they were coming late to the party, and the party had already ended and gone somewhere else. Well, it looks like that's the case. Over the last couple of days, the party has moved on to somewhere else. But that doesn't necessarily mean the night is over, right? Just because the locations of the parties change. In other words, we've had a nice little rally. We've had a pullback the last couple of days, but neither one of them should be taken into, out of, or taken more seriously than what they really are. And that is just these kind of space filling moves. What do I mean by that? I'm going to break that down in today's video. Talk about kind of what's driving this action here lately to the downside the last couple of days and what significance that means. And we're also going to break down a trade idea. How do you, like with all these really good bullish charts, how do we find any bearish trades in that, and what kind of patterns do we want to see so that we don't just get caught up in a pullback trying to trade a bearish move on a pullback. So we're going to look for that with today's trade idea and show you kind of what kind of patterns to look for. So let's go ahead and get started. Today is Friday, May the 1st, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. You can see the pullback we've had the last couple of days since our last video that we did. Brought the intermediate line down finally today, but you see it's still above 80. In fact, it's still above 90. So, we still have a strong bullish posture. Actually, when combined with this pattern here, is actually a pretty short-term bullish pattern. Very similar to one we had over here, where you had an oversold momentum line, a near-term line down in the lower half of the chart, but a bullish posture. In this case, it was like a rising bullish posture. Here, you're in there. You're in the reversal zone. So very similar setup here that we had that led to a 6-day run of opening gaps of at least 0.5% or more. So very significant from that regard. And actually today's gap was pretty comparable to what we saw over there. In fact, when you look at our gap study here, you can see that, especially when we look at SPY, you can see that we had a pretty significant, there's a 1 standard deviation gap to the downside. The last time we had a 1 standard deviation gap to the downside was over here. Now keep in mind, we shouldn't be getting 1 standard deviation gaps to the downside in the bullish market anymore. All these times over here when we were so bullish, we stopped getting them. All the way up until about right here, we finally got our first one. We had a couple in these, a couple that just turned right into some bullish moves. They were actually they were more bigger than 1 standard deviation at the time. If they're too big, then we can bounce right off of them really quickly. Or we can continue lower, and that's what ended up happening here when we got a pretty significant. This one ended up being, about 3 or 4 standard deviations to the downside. In fact, you can see here on the gap study that we have, SPY ended up gapping down 5 standard. That was a 5 standard deviation gap to the downside. So you can see how significant that is in terms of causing a new intermediate, at least an intermediate pullback, if not more than that. So now, of course, when you go further out from here, there's your 124 or 224 gap right there. This one. That's what it looks like now. So, so put that into perspective. We had some of these are 5 standard deviation gaps, and you can see how we didn't really move very much throughout the day on them, and we ended up rallying. But we don't get these kind of big gaps while we're in bearish, bullish trends. We start to really grind lower here without them. So. In fact, go back to this 127. That was our biggest gap that we had to the downside during the bullish trend before this really big move started. So we'll go back to 128 of 19 here. And you can see, okay, there's a few. We had one right there we bounced right off of. We had one right there we bounced right off of. Both of them above their moving averages, easily above their moving averages. This one was a much bigger one. And it also kind of came down and finished right about at that moving average before bouncing up a little bit. But you can kind of see how small they are and how when we're not so bullish anymore, and this was kind of the red flag, right? This was the China coronavirus issues. That was our red flag that things might turn around. It wasn't quite 5 standard deviations for the time, but it was still pretty significant. Pretty significant there. So keep that in mind now. This is, it was a 2%, roughly 2% gap that we had this morning, about 1 3/4%. Now we'll see if we end up following up with that. There's a nice tweet. I guess nice is a relative term, but there's a tweet here coming from Mike McCurr at TD Ameritrade that talks about, since 1970, when the market has fallen on Fridays by at least 1.5%, more often than not, we go down to a lower low of almost 2% the next Monday. So, and that might very well produce what we need here to come down and to fill in that gap. We talked about this before in previous videos, especially on the Wednesdays videos, that these are all common gaps, and the expectation is that they start to get filled in. Well, this one started to get filled in yesterday, finished getting filled in at the open. We filled in by the afternoon. We filled in here, and then you can see obviously later today that we filled in. We're getting closer to filling in this gap, and that's the one to kind of keep an eye on as we head into early next week. If we take a look at the Russell 2000. It had caught up so much. Well, just like that, it's pretty much lost all that catch up over the last couple of days. Pretty significant downward move, but still in a bullish posture, right? Still got a dark green shading in the green line. Obviously, we're not nearly as bullish as the broad market as a whole, and you are still getting also that bullish intermediate confirmation signal. And keep in mind too, we're still like this space between these retracement lines. It's just space, so we can go up and down pretty easily. The concern of going back down again and staying, like going down potentially to lower lows, like trending down, that concern really starts to amplify when you get below that 23% mark, right? That's when the retracement starts. Then you have resistance. This is our resistance zone that you can trade at the bottom of or at the top of, very similar to an Ichimoku cloud. Well, now once you get into it, you can trade anywhere in that range, in that space. Breaking through it, so, now we start looking for a reversal, a trend reversal. So right now we're just in that space of that resistance zone, and we're still actually in it. And the S&P 500 hasn't broken through it either. It's still in that area too, and it's got room. It would have room to fall as well. If I were to take a look at its 1-year chart, I'll have to zoom out. If you take a look at its 1-year chart, it hit the 62% Fibonacci line here, and it's not even back below the midpoint yet. So it's still in the upper half of that space. So when we're in space like this, things can get noisy to the upside, as we saw the last week and a half. They can get just as noisy to the downside, and not necessarily be trending yet one way or the other. So don't get caught up in these moves as thinking, okay, here we go to the upside. Don't get caught up in the downward moves as thinking, well, here we go. We're going to tank now back down to the downside. No, we're just eating space right now. Within whatever volatility bands you like to use, whatever it's retracement zone, whatever it is, we're basically in the mode of just eating space, which makes it very easy to go up and down with decent sized moves and still not necessarily be trending. As always, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below this video if you're watching us on YouTube there. That will notify you when these videos are posted. Hit that thumbs up icon that's down there too. That tells us two things. Number one, you liked our video today. Number two, that you want us to do it again on Monday. It's a quick way to give us feedback and tell us that you like our videos, that you want us to keep doing them. If that's the case, you can do one click. Let us know right now, even right now while you're watching. If that's not the case, you don't have to click on anything, of course. Also, while you're down there, comment on anything that stood out to you from today's video. What did you get out of it? Love to see what you're getting out of our videos. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen that will take you to a page where you can subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching our video on our blog here, you can see there's other things here on the page that you can check out. We have our May calendar, our class calendar up. So it's got all of our trading rooms, all 8 that we do every week, plus the 2 Q&A sessions that we do for our premium subscribers every week as well. That's what's coming up here tomorrow morning for me. We also have our daily, or our Market Outlook live video that I do on Monday, Wednesdays, and Fridays, where we review all of our past trades. We've closed out a few trades here recently. I talked about that today. Sent out an alert this week to our premium subscribers about those as well. We've already put on today's trade idea that you'll see at the end of the video. We've already put that on today before the market close at 3:30 Eastern. That's when we do these. We do that. We put on the trades during that. You get access to all of our trading rooms and that Market Outlook live video with our monthly subscription that you can check out right here or up here at the top. Our plus subscription, our premium, of course, there's the details there, and if you just click on pricing, it will show you the difference between the two, what you can get out of it. We also invite you to hit this this heart. It opens up this window. You can like today's Market Outlook tweet, hit that thumbs up. You can like today's Market Outlook Facebook post. Again, the more you do that, that benefits us because those platforms will promote that content with all the likes to all of our followers. It also benefits you because it lets them know that you like our content and that you want them to promote our content to you. That's how they find out, and they'll make sure that you see all our stuff in between times that you log on and get onto your platform, whether it's Twitter or whether it's Facebook, especially Facebook. Today's close, the last 2 days for that matter, had an interesting effect on the Hakinyashi candle for the week. So we were really bullish going into this to go after Wednesday. Remember, if you recall, the Hakinyashi close was a lot higher. We were well above these past 2 weeks highs. But this last couple of days of selling has brought the Hakinyashi close down towards 28.65. Now remember, the actual close is, we actually closed below the Hakinyashi close, which is not, that's not necessarily bearish, but it's also not as bullish, right? Usually when you're looking for like signs of bullishness, you're looking for higher highs, higher Hakinyashi closes, and you would like to see no lower shadows, and you would like to see the actual close above the Hakinyashi close. Kind of that first sign of weakness that we're not as bullish as the trend suggests is for us, and it would be even more bullish if you close the Hakinyashi closes above the prior week's highs. But that first sign of weakness that we're not as bullish is that we don't close as high. We don't close above the Hakinyashi close. We close below it, because that means this next week's candle, next week's open is going to be right around 28.20. We're already trading at 28.30, so that means there's a very good chance that we get both a upper and a lower shadow next week. I mean, we traded 81-point range today. Well, even bigger than that when you count the actual range, but we traded, this is a weekly candle, so this week, this had 188 point. 10 points is nothing when you're in that 188 point range. The week before that was 154 point range. The week before that was a 265. So again, 10 points is nothing. So there's a very, very good chance, not 100% because nothing is, but there's a very good chance that we have both an upper and a lower shadow. And if we end up closing around 28.20, then the Hakinyashi, then we end up with a reversal, like a transition candle. So we'll see if that ends up being the case, especially if we end up getting back down below this 50-day moving average, which that's a long upper shadow heading into a 200-day moving. Long upper shadows are bearish, especially heading into a resistance. Now it's a 1 week pattern, so you kind of have to confirm that. Just like long lower shadows are when you've had a bullish move, a long lower shadow like that can be bearish too, just not nearly as bearish as the long upper shadows. And then you need to confirm it. So we'll see, and you can see this long-term trend line is still kind of in the mode, but you also see that we're still in space, right? We can come down and still just be in space until we break really below that 2650 level, and then that's when you're like, okay, there's a good chance we continue to roll down. Of course, getting below this 2450 level would be like the final straw, the final confirmation that here we go, most likely to not only filling in that runaway gap we talked about over here on March 24th, but going all the way down potentially towards 2100. That's probably the less likely scenario. The more likely scenario is we come down to at least 2650. If not, my worst case is probably down to this 2450 level area. If we take a look at the 3 green arrows, On the S&P 500, you see we don't have 3 green arrows anymore. We have 1 red arrow finally on the MACD. Let me show you what that looks like on the 2-line version. Essentially, the MACD is finally crossed below the moving average. Right, the MACD is finally crossed below the moving average. The stochastics has also crossed below its average. Now, we've taught before, stochastics going up and down above its average like this is not common for a. It's very common for a bullish move. It's not common for a bearish move. Usually on a bearish trends, we just roll right over. So keep that in mind, that we could, again, 2450 is down to here, filling in this gap that we've talked about before. 2650 or 20. That would be the 2650. The 2450 would, well, actually the 2450 would be coming down into this spot and filling that gap. The 2650 would be up a little bit higher, would be right in this area and right there. So barely coming down towards that moving average. That's where the bottom of the retracement zone is. Still that space. So if we fill down there, you're going to get some bearish moves in these two lines, in the MACD and the stochastic indicators. You're also going to get some bearish moves in these other oscillators like the RSI, which was not unable to get above 60. It's still at least above 50, but it was unable to get trending, and this was unable to get above 200, and both of these appear poised to break below their midpoints. They haven't been below their midpoints this whole time. This would be their first break below their respective midpoints. So important to watch here next week. And then of course the other important thing to watch next week is the DMI. We're going to get another bearish move. Just a reminder on this, the biggest moves in the DMI occur early in a move, right, and then in a bearish move, and late in a bullish move. So if this is indeed going to be, the end of a bullish move, and a bearish move might come pretty sharply and pretty suddenly. Let me show you an example. Let me go back to 2009 here, and then we'll go over here to 2008. And see, okay, we had some big bearish moves there, and you can see as the DMIs came closer, we still kind of went some ups and downs, but then you had a big bearish move there, and then these lines came down, and a little pop back up there to a lower low, but then we pop back down again. Then we had kind of a big bearish move, and we came down, and we started to grind higher with a bigger bullish move going from there. So we'll see if we end up getting kind of a pop here in the bearish mark. Right now, they're okay. I mean, you're above, you did drop down below 30, which when you get above 30, you like to stay there. And when you look at the Ichimoku cloud as well, we're still above the cloud. Even though we popped below that 20 line, there's a pretty decent sized gap that we can fill down towards the blue line. Neither of these lines got to the strong bullish trend mark. We were in that sucker range of a lot of those oscillators where we look bullish, but we're not really solidified in that trend yet. And now we're starting to roll back down out of that sucker range, and still filling in space. This concept of filling in space. I mean, we could drop down. The 2650 is right here. 2650. Now, if we drop to 2650, there's a pretty decent sized volume gap until you get down to 250 on SPY, or 2450 on SPX. So that's why it's like we can come down here pretty easily. There's not very much volume here to the downside. If you look at IWM, you see something similar because we've gone up so much. There's a pretty decent sized volume right here. We've been trading so low. So and there's not very much volume up above where we're at right now. So that's something to keep an eye on there. But if you look, we can fill in space. If you look at its Keltner channels, another volatility band, you can see we're just, we can fill in space down to 2650 really easily. There's nothing that would say there's some strong support here in the middle that's going to hold us up. No, we can go up and we can go down inside of space really easily. The difference now versus say somewhere over here is that space just happens to be a lot bigger, and that's why the moves both to the downside and the upside and back down to the downside are a little bit bigger than normal. All right, now let's take a look at the intraday chart here, and you can see how we pulled down towards this point of control area. You got some volume here today. That's what built this up as the point of control. We have a few days of volume in this area as well. you can see getting down towards 265 would be down to this area here. You'd be breaking some levels, layers, some intraday layers of support here at 280, and then another one here right around 273. Once you break through that level, it's going to be hard just to stop at that 265 area. That's the gap where we're looking to fill, right? If we fall through that zone, that's actually the 265 zone at SPX. If we fall through this, there's not much holding us up. And then you can see how easy it would be. It's as far as this looks away from here, and this would be that 2450 area on SPX. As far away as that seems to fill in that gap, that's not the March 24th gap, right? This is the April 6th gap. As far away as that is, if we don't hold that volume node for support as we fill in this support area, that's if you notice the 23% Fibonacci area, then we start coming back down a little bit lower here. Now, granted, that's the Fibonacci, that's this Fibonacci, this long-term, very, very, very long-term Fibonacci area. Now let's take a look at the volume today and how that compares. Today's volume was a little bit higher, kind of ended the week with some strong volume, right around 125 million. The trading range, like I said, above the average at 9 points. When you look at that in comparison here, right here, you can see that 9 points is right around 3%. And I've told you before, the market generally forms the low point after you've fallen down. In the admittedly few examples that we've had sharp increases on the ATR above this 5% mark, in this case getting up above 6%. In those few examples, obviously they're big time moves that produce big time lows, but then again, we don't form that. Even if it's a higher low, we won't form the low that will start the new trend until after we hit this 3% mark, and that's the 9%. That's about 9 points. So we'll see. If we continue to get really small ranges, then that's bullish, right? Then we'll break through the 3% and we'll get going here, and then of course, like I said, nothing's 100%, so we'll just kind of keep going. But if we start getting 10-point ranges here next week, or plus 9, 10, 11-point ranges, so we bounce up. We're not going to bounce back up to 6, but say we bounce up to 3.5, maybe up to 4%. Then you can see that won't be as big. We had some huge ranges over here, but 10, 11, 12-point ranges, that's about what we had today, just a little bit more than what we had today, and it would just kind of grind our way down potentially into this area. And you can see the volume, 125 million, slightly below the average here. That's falling, but you notice when you compare it to what we've seen over the past 5-10 years or so, it's still relatively high. I mean, it's still a high level, only breached by these pullbacks, right? All the other periods well above. And keep in mind too, when you compare it to this period, this volume is higher because the price is lower. The price is much higher up here. So again, 125 million at 282. If you kind of give you an idea here, 125 million shares trading at $283. That's $35 billion versus, say, down here, over here, you had 125 million roughly, in this area, say like kind of in this area here, you're at about 125 million, and the S&P was trading there at 186. So $186 times 125 million. Now we're looking at 23 billion. So a much different number. So there's still heavy volume. There's still a lot of money trading relative to peaceful times. And even then, even during those peaceful times, it would be the jumps in volatility during those peaceful times. So, again, kind of an area where we might bottom out temporarily while the market itself consolidates a little bit more in this spot. Finally, let's look at the VIX, and you can see today's VIX jumping up towards 40 again. The last couple of days, we've come off of 30, and just like that, gone up to 40. We're back around the 100% mark, though we did finish the day below 100%, but kind of watch for, usually when you get these big volatility spikes, we come down, we hold the 95% mark for support, and then we generally run back up towards this 105% mark like we were here. So this week, getting close, we made a run above, but we still finished below. I don't necessarily think that that's done yet. So keep an eye on volatility and how it behaves next week, expecting it would to continue to move potentially higher into this 40 to 45 area. Again, I don't expect, even as we said before, even going back to 2008, 2009, it's not going to show you the VXV, but even going back into the spot, well, actually it does show the VXV. It's before 07 that we don't have that anymore. You can see when we did pull back down into the 95 spot, you see how we held, and then on the subsequent, when we formed the low point, it did jump back up in this 100 to 105 spot, and that's the kind of move that we expect to see over the next, so many weeks, month or so, as hopefully to consolidate these gains, because that's the low point. And you notice it didn't get close to 60, 70, 80. It got up in the 50s though. It got up to high 40s in the 50, and so kind of watch that level to see if we get up into the high 40s in that area again as volatility rises during this consolidation. Again, 10-point ranges, 11-point ranges. We're not talking like another move like we saw. Nothing even close. That's not how consolidations occur. That's how they start, right? That's how these big moves to the downside start. You get that big sell-off, that extreme sentiment. Then the consolidation's a lot slower. So as much as we like to see things fall hard and fast, and we like to see things bounce hard and fast, that's just not how that's not how the markets normally work. They fall down fast, they recover, and then they consolidate. And this consolidation is not nearly as fast as a lot of people would like it to be. It doesn't necessarily mean that we have to be significantly bearish anymore. The consolidation might go to lower lows, most likely, and even 1929 didn't go to lower lows. All right, we consolidated, then we started the bullish trend for a few months towards the 200, above the 200. Then we failed and things got hairy. But that, after the first sell-off in 1929, it was like this. And once we bounced and consolidated, the consolidation didn't get to lower lows, just like we wouldn't expect this one to. And it didn't have the same, just sharp, pressure day after day. It's just more kind of a grinding downward move. I picture grinding in bullish trends as small, slow moves. This won't be small and slow, but it'll be a lot smaller and a lot slower than the types of moves that we saw over here. All right, before we keep going and show these different market relationships and what's going on next week and our trade idea of the day, I did want to summarize. We have a strong bullish trend. We are in the midst of a pullback. We are just filling space right now, both to the upside and the downside. So don't get too caught up thinking how bullish we are during the upward runs. Don't get caught up in being too bearish. If you watch our classes at Market Scholars, you'll see how I have both bullish and bearish trades right now, because there literally is no trend. And if you look for trends in small moves like the 6 day in a row opening gap, thinking, okay, here we go, bullish trend, then we have moves like this, right? And then if we look at this as, okay, here we go, we're going to really tank now, and that second leg lower, probably is not going to be the case. It'll probably just be a kind of a nice consolidation within space without breaking to a new trend to the downside. And so we have the ups and downs, and it's very important to stay neutral there and make sure you have plenty of upside and downside trades until a clear trend emerges where you can start to be more actively bullish or more actively bearish, depending upon which way we break. So what do you think? Do you agree with that? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll. Hit either agree or disagree. If you click disagree, comment down below as to why. What do you see that either makes you a lot more bullish than I am right now, or that makes you a lot more bearish than where I think this consolidation may lead? So let me know down below. All right, now let's take a look at what's driving the price action today. And you can see, again, the beginning of the week when we did this video, it was a nice, good run on IWM, had caught up. International stocks was outpacing the S&P. Value stocks did okay. All the crap, right, was leading the way higher. Since then, then a lot of that has fallen back. And we talked about this concept of, We want small caps to lead the way higher. We want value stocks to lead the way higher. We want international stocks to lead the way higher because of a falling dollar. Those are things that typically should lead the S&P when we're coming off of major low points. And that hasn't been the case off of this low yet until these last so many days. And then you can see, we talked about that. Well, maybe that's a sign that this run's coming to an end. Well, it did, and crude oil bottomed out at least, and it started to rally higher off of really extreme lows. And you can see, as bearish as we were, we still ended up down this week on bonds and on gold. So it wasn't a complete risk-off week this week. In fact, unless you only look at the last 2 days, right? And of course, when you look at just the last 2 days alone, then you have a more significant decline, right? You have 3.5%. You can see small caps doubling that return. So I mean, that's not the kind of trend we like to see. When we're looking for the low point to form. You can see crude oil had a nice run, but even these two down days, they outperformed, but the dollar was down, gold was down, treasuries, long-term treasuries were down. I mean, everything was down. International stocks, EM especially, which is not surprising, everything was down these last couple of days, and that's kind of typical. I talked before about this relationship between QQQ and IWM, and you can see the bubble that since the beginning of the year. I mean, it was on a pretty steady bullish trend, but then the beginning of the year it just went parabolic, like Tesla. I mean, it looks like Tesla here. But since then, in the last little bit, and like I said, really just the last few days, if you notice, that relationship changed. It was about a week, but the last few days, those first few days of the week, we really dropped down to the 50-day moving average of the relationship. And it looked like, okay, here we go. We're going to break through 40. We're going to start a bearish trend on this. And that's kind of what you want to see. Nope, we hit 40 as support. We're back up above 80. The MACD didn't cross below 0 down here. It appears to be rounding out. Obviously, there's your bubble where you had the big spike up to 90 in the RSI and your big spike in the MACD. We've obviously been trending lower as we lose momentum, but we still haven't crossed 0 this entire time. In fact, it's been rare that we've been below 0 for most of this last 5 years. Here's the 5-year chart on a weekly basis. Look at the MACD and the RSI are still really darn high. And I've said before, and I've showed you on the comparison chart, when this comes down, when the relationship corrects itself, it usually corrects itself with both of these falling, but not with IWM falling more, but with like QQQ falling more and SPY, which right now is pretty darn near correlated. When you look at the correlation here for the S&P, SPY, and we'll correlate it. We'll correlate it here. Here we go. Correlate this over the past like quarter, the last 3 months, 63 days, and we'll go to QQQ. You can see very, very high correlation near. I mean, like I said, this is just today alone. Let's go to this one. 96% correlation. We only had a brief little dip here in March, but for the most part, really strong correlation. There we go. There we go. Now you can see the chart here. So for the most part, very, very highly correlated. So when you see the S&P and you see the S&P, you're basically looking at the QQQ. So again, this has got a long ways to go. Now these are here. Let me change this. These lines here because they are 50 and 200 weeks. Let me update them to 10 and 40. So there's your 50-day moving average. There's your 200-day moving average. If we can still maintain a bullish trend, but we got to fill in that gap here, and that kind of consolidation or correction doesn't usually occur during bullish markets. So it'd be ideal if it can occur during the same time that we get that consolidation down into this area. And that's the worst, right? If we can do that and the S&P can hold and some of these big cap names can hold, then that would be the ideal scenario. Because then we can bounce off of that with that relationship now hitting the 200-day moving average. Then we can bounce off of that and make a run, right? And again, it's a relative strength chart. So we can actually still be bullish, and that chart can come down. It's just more likely that we ended up being relatively bearish. As I showed you before, when I think the bear market started in January of 18, the IWM was doing okay as it should. It comes off these lows. Then we started to have a little bit of outperformance in QQQ, and we took off. And you can see the gap, shrinking as it falls down. Then we really kind of rallied, and that gap extended. We pulled back. It extended again. We have some consolidation, and now over here we've really extended. Right, this little. In fact, if I change it now to this October time frame, was October the 3rd. I believe it was the 3rd when we peaked over here. Was it October the 3rd when the S&P 500? Well, this peaked in August. October. Again, you can see the gap here. We were pretty much close to break even in IWM from that October high point. When we got here to February, we were 30 percentage points gap difference. By the time we fell, the IWM was way down here at the bottom, 40 percentage points down here. So now we're over 32 points difference during the pullback. So the gap got bigger during the pullback, and of course now we have a 38 point difference. So the gap has even gotten much bigger. So that gap needs to shrink. Typically shrinks when we have not this type of move, but any kind of consolidation move. It's when that gap shrinks. You can see even the Fed, the market for the Fed funds futures, they were going all the way out to now March of 2021, and there's only less than a 3% chance that we'll have one rate hike by then. That's it, and of course that's going to be a function eventually of what we see here in the long-term inflation expectations rate. And it's really kind of it's stopped the bleeding, right? All the Fed action here has stopped the bleeding. It hit the bottom on March 19th, but we've consolidating and we've been rolling back over, and we're still extremely low. These are long-term future inflation expectations. So until we get any kind of move back up towards 2% or higher, if you go back to so many years back when they started to raise rates again, they started to raise rates in December of 2015. We were still close to the 2% mark, and they only did it the one time. And then they raised rates again in December of 2016, but we had gotten back up above the 2% mark by the time that happened. And over here, they were just trying to get off of zero in December of 15. We were high enough to warrant. We were still kind of flirting with that low end at the end of 2010. They had the opportunity to raise rates over here, but remember, in 2013 they did QE3, the indefinite QE3. But now, see, we're not anywhere close, so we're not going to get anywhere close to a rate hike anytime soon until we get into that 2 to 2.5% area. Probably going to have to break through this 2.3% before we start sniffing any kind of mentions here of a rate hike going out however far, especially when you have economic indicators coming in well below their estimates. We've seen like 2008, it's been down that far before. On a global scale, we're at 132. That's a lot lower than we were at, but that just kind of shows you from an economic standpoint where we're at and how far down. In fact, the Atlanta Fed GDP estimate for the quarter, remember, it was down 4.8% here in the first quarter. It's already expected to be in the second quarter 16.6%. So there's some pretty low estimates for GDP. Now that doesn't mean the stock market doesn't care. Like, the stock market prices in expectations, so those expectations really have to start ramping up before stock prices start trending higher and break out of this consolidation mode and this space filling mode that we're in right now. Okay, when you look at the sector charts, you can see just how strongly bullish we are, how bullish this move has been, and how this pullback hasn't really changed anything. Dark green shading still across the board, green lines still across the board, except for utilities, which is a little bit more bearish, and real estate, which is getting closer to its moving average. Staples also kind of getting close to in that spot. But everything else looking pretty darn bullish. So, again, not something to get too worked up. Now, you also keep in mind, too, these are all 3-month charts, and you see how these are some pretty strong numbers for some negative declines here. But you have, intermediate lines still in the 90s. You have that one up at 84. And even with this couple smaller numbers there in healthcare and staples that are doing much better, they still have really high intermediate lines. But otherwise, some pretty negative numbers. It just kind of shows how steep the pullback was to get to these lows. And the bigger the pullbacks, the bigger the bounces. The bigger the rallies, the bigger the drops. And we had a pretty decent move heading into this, not to warrant that type of drop, obviously, but maybe to warrant at least this one. And that was a pretty decent sized drop before we had the Saudi Russia oil spat that really exacerbated this coronavirus issue. But maybe that was all because we had such a a big move to the upside that preceded that. But a big move to the downside usually prompts us big of a move, or a pretty decent sized move to the upside, and that's where we're at. And now we're getting a pretty decent sized move to the downside. A few percentage points here, five percentage points there. But as big as those numbers are, it's not really having an impact on these charts. Which just means you have to be really picky with your trade idea of the day. And so we want to take a look and take advantage of the turnaround here to see, okay, is there anything bearish that we can add? We've had a lot of bullish deltas trades in our portfolio. They have a long time frame. We don't have as many bearish delta trades anymore. So how can we replace some of those? You want to make sure you're getting stocks that have bearish looking technicals that aren't just pulling back from strong highs as we see a lot of stocks are. We get to a stock like Baidu, which it has ran right up to its point of control in the 1-year chart, and it's since started to roll over. Has earnings coming up here. If you look at its market forecast chart, it's got kind of a quasi bullish pattern. But again, is it that kind of pattern where you have light green, light pink shading and a yellow line that leads to a reversal instead of a bounce? With the intermediate line rolling over here and getting this kind of bearish near-term high without getting above 80, there's a good chance that ends up being a lower high point, especially when you factor in the weekly chart. And you can see we are still dark pink shading and green line, or red line, there. You can see on the long-term chart here for Baidu. No, that was it. This is the Baidu on this chart here. You can see still death cross environment, have been for a long time. Bear market in these international stocks started in January and really hit hold in October, and you can see the big declines that a stock like this has had, and it's still unable to get going. This big downward move, which again, this big 30% move is as big as it was, more typical of ending of bear markets than it is beginning. So the S&P and QQQ especially doesn't look like this. When you look at, if I throw on a comparison here, so you can see QQQ in relation to this, since that's the same type of stock, right? Then you can see a big divergence here. Like, since this bear market really started here in August, October, kind of in this area, both stocks fell, but then as we rallied here, we didn't quite get the same rally on Baidu back up to these highs, and then especially we didn't get the rally, as we fell back down here, we fell a lot lower. This period of volatility that we had in the Qs and in the market as a whole, it produced a pretty big sell-off in a lot of international stocks. Then we had a rally and rallied this at the end of the year, just with everything else as typical. Obviously, much higher highs on QQQs, not even close to higher highs on Baidu, especially compared to these back here. And then you can see now lower highs with lower highs. And obviously, much less lower highs. In fact, this low point that we had over here at the bottom of this consolidation, we're already below that low point, whereas Qs are up above it. So this kind of shows a relative weakness that we see in a stock like this, and that's a type of stock with falling momentum again that we want, long-term momentum that we want to see if we're going to do any kind of bearish trade here. You can also see too getting below the 30-day moving average. The 8 and the 17-day are both close to crossing. The MACD never did get really, the moving average of the MACD, the orange line, never really did get above 0. We got the, we didn't get above 80 on the stochastics. It's already rolled over. If you look at its RSI and its CCI, they never did get above 60 and 200. They're rolling over to the downside, almost back below 40, almost below negative 200. You look at its DMI chart here eventually, and you see, okay, the blue line never really got going. It got close to being above 30, but couldn't really get going. The negative never fell below 20, and now they're flipping spots with the ADX as low as it is. You also see too on the Bollinger Bands, I didn't mention this, but the Bollinger Bandwidth had really fallen down, so it's opening up for an expansion of the bandwidth, which means we got to move one way or the other. So which band are we gonna guess that it's gonna push? It can go either way, but the guess right now, based on the current technicals, with all the other charts too, is that we'd go to the downside. And you can see even on the Ichimoku cloud, being below the cloud makes that most sense for that possibility. And you can see we have this little strength that we've had in the last so many weeks hasn't changed the fact that the long-term trend is still close to moderately. It still is a weak bearish trend. It's not as strong as it was when we were down here, but we were still below that green line. We're still kind of rolling over, and obviously well below even the weekly cloud. Kind of give you an idea, we're not below the weekly cloud on the S&P with that long upper shadow, as bearish as that is, but the strength still hasn't changed the fact that we are in at least a moderately strong bearish trend still. So that just shows how sharp that move was, and how, as big as this rally has been, it's not been enough to get us back to a noisy trend, right, where we kind of halt the move that we had previously. Kind of show you how rare it is to even have a bearish trend on a weekly chart. I mean, the last one that we had was 0809, going into initially the beginning of 08, and then we had the test and we got a little noisy, and then there, and then of course 02. I mean, these are recessions, right? These are bear markets. All these are just kind of minor pullbacks. 2015, there's the 2011. You can see there's our 2008. They got a little bearish, but never, not nearly as extreme on the bearish as we had just temporarily. We had, we were above 5, we were above 80 on the weekly chart. That's pretty darn rare for us. We never did get there here. We never did get there here. We never did get there over here in 2011. It was just all noise because of how bullish we were coming off of that 09 low point. We never really got there over here. We got pretty darn close at the beginning of this move, and it was just temporary as we bounced back up to the 200-day moving average and then rolled back over. So, that's as bearish as we've been. This is not too often that we get this bearish. So, don't be shocked if it takes a little bit of time to consolidate that. But to get back to the trade on Baidu is to sell, or is to buy a put, right? We'll buy the $85 put, as you can see right here. And let me get to the market outlook category here. Not in the May, it's going to be down here in the June, because we want to give ourselves some time here to get through that earnings. But we're going to buy the 85 put. We're going to sell the 80 put. That covers a lot of our costs. You can see what the trade looks like. So if we break out to the upside for whatever reason, then we have a good opportunity to keep my risk really low. At most $700, about 3/4 of a normal position in this class example. But at best, I think we have a pretty decent chance that we can get out at half of that. So about $390 or so. But for the potential reward of $3,200, which is within the realm of one standard deviation move to the downside, that's a pretty decent opportunity. Very good reward to risk ratio, knowing that our resistance is right here. Very strong resistance right here, and very, very little support in this area. All right, so that does us for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. It takes you to our Market Outlook forums at marketscholars.com. Open up any new threads with any questions or comments you have. and then reply to anybody else's, and let's keep this conversation going in between videos here over the weekend. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video down below. Follow me on Twitter for more content. Join our community at marketscholars.com, as well as our Facebook group that we've created. Have a great rest of your weekend, everybody, and we'll see you all next time.